Well, hello, everyone. I mean, when Thierry says nearly every famous internet company on the planet, he's not actually wrong. I can count Facebook, Zynga, Twitter, Flipkart, Spotify, Groupon, JD.com, Xiaomi, Ola Cabs, Alibaba, Airbnb, and I'm running out of breath, so I'm going to stop there and get straight into the discussion. Look, John, the thing everyone wants to know most, really, about DST is sort of the investing philosophy. What are you looking for in an investment?
Yeah, absolutely. Very fair question. The first thing that I would say, though, is that it's a little bit unfair to compare our portfolio with the average VC. And the reason for this is that, obviously, as a late-stage investor, it's actually pretty easy to pick the potential companies. Obviously, they're all late-stage, super successful companies, successful founders, whereas the VCs, they go out and look at, you know, a number of companies which is much larger. So that's what I would sort of say in defense of our VC friends, that for them it's much more difficult to pick the companies relative to what we do at DST. Obviously, the challenge that we have is that we're then coming in at much higher valuations. Yeah. So for us, it's also very much a valuation challenge. For VCs, they're probably a little bit less valuation sensitive, you know, as long as they get the right companies. But coming back to your original question about investing philosophy, what we really try to focus on are companies that are category leaders or are on a path to get that category leadership, so that they can basically dominate their competitive environment and create competitive moats around the business. Without exception, every single company that we have invested in, and we've invested in roughly 35 companies over the last 7 years, so 5 companies per year, every single one of them have been led by a fantastic founder or by a very strong founder team. So obviously, you know, the founders in fast-growing tech companies, they obviously play a really fundamental role in guiding that company. And in every single company that we have invested in, the business plan that we look at, you know, JD is a good example. You know, we looked at the business plan and did due diligence in late 2010. Obviously, many things turned out to be completely different. We didn't anticipate that they would go into new areas like the third-party platform for other merchants, opening it up like they did, like Alibaba, you know, obviously started out with at Taobao. We didn't expect that they would go into financial services. We didn't expect that they would go into on-demand delivery and a number of other areas. So things obviously turned out different, and that really means that backing the right founder who can, you know, not necessarily pivot the business, but sort of change direction and come up with new businesses is critical.
So you're looking for someone with a coherent vision more than someone who really understands how to run a business? Ideally both, I'm guessing. Ideally both. How many times do you find both?
I think that, you know, in the 30 plus businesses that we invested in, I think that we really have both. So you obviously have to have a very strong vision, great leadership, and execution is obviously absolutely critical. You know, there are a lot of people with vision and, you know, motivational skills and perhaps even leadership skills, but unless you can really figure out how to execute day to day over a long period of time, you're just not going to get there.
Now, I've heard DST partners, and there are only 5 of you, described as walking encyclopedias of internet business models. How do you first go about finding companies? How does a possible investment pop up on your radar? Yeah,
it's a good question. So what we try to do is we invest globally. So we try to compare, obviously, similar business models across the world. So one of the companies that we just didn't get at early enough of a stage was Uber. But as a result of having spent some time with the Uber team, we then ended up making other investments in this space, like Didi, Ola Cabs, and Gojek in Indonesia. So I think that that's why it's so important to be able to compare business models across geographies. And, you know, you can look at e-commerce companies, social companies. You know, there are really interesting lessons to learn when you compare these different models across geographies. And normally, I think that the best ideas come from other founders. There's no doubt that they are the best referrals to us when they come from other founders. But of course, we want to have very close relationships with VCs. They have attractive portfolios, and there would always be strong VCs in the companies that we end up investing in. So we want to spend time with all of those VCs, know the partners well, and those are probably the two key areas of deal flow for us.
I mean, when you say they're about business models and comparing across geographies, I'm still thinking that something won't work the same in China as it might in California. Or are you saying there's more similarity to the principles?
And I think that that's exactly what you need to figure out. So something that works in California or works in Europe may not at all work in the same way in China, and certainly vice versa. So I think that, and it's also the same with India and perhaps even within different countries in Europe. So I think that that's obviously what the founders need to sort of figure out. This is a general model that, at least in the past, typically ended up emanating from Silicon Valley, and then it was basically sort of adjusted to local needs. But now we actually see innovation taking place in many other areas than the Valley.
Yeah, China for one. Now, when you find an investment or something you like, when a company's come up on your radar, I don't know, Mark Zuckerberg said, have a look at this one, this is interesting. How long does it take for you guys to make an investment? What's the process?
Well, it's very, very situation specific, of course. What we try to do is that we don't want to wait until companies get to a late stage. Mm-hmm. What we try to do is actually have dialogues with companies at a relatively early stage, follow how they're doing, and develop a relationship so that, when they actually end up raising funds at a valuation that makes sense to us, that we don't meet them for the first time. We want to know them from 12 months or 18 months or 24 months before. But normally the investment process itself, it can be as short as 2 weeks to several months. It obviously depends on if the company has information available, how competitive the process is, have we known the company from before, etc. So, but I would say that at very, very short end, a couple of weeks and typically a couple of months.
So at the short end, I'm assuming someone didn't just pop up on the radar and you go, yes, this would be a company that you've known probably for 12, 24 months, and then you can move quickly at the end.
Exactly. And then remember, the only what we really focus on is consumer internet. So there are other investors that look at the whole gamut of technologies from semiconductor, software, internet, consumer internet, etc. We only focus on consumer internet. So we think that we have a relatively sort of decent understanding of different players in a particular market.
I mean, when you do finally invest, you tend to go in pretty big. I mean, you're part of a late stage round. But is the fact that you can commit in size, is that an advantage? Does this hold you back from, I don't know, some possibly really attractive smaller investments?
I think that it's definitely an advantage because many companies, they do want to have investors on board that can, at a later stage, provide more capital. I think that just makes the growth process easier for them. And what we quite often do is that we come in with smaller checks, and then as the company performs and as the capital needs increase, we end up committing more capital. So we might start with a smaller check and then end up investing a lot more over time.
Now, you mentioned there your friends in the VC world. I mean, you guys are very much late stage, but then you're saying there you might come in an earlier round in smaller size, so you're there in the later stages.
Yeah, I think that what we don't want to do is that we don't want to compete with the VCs. So I would say that, generally speaking, if the valuation is less than, let's say, $500 million, we want VCs. VCs are going to take the lead on that. At that stage, companies wouldn't really raise more than perhaps 30, 40, 50 million. And that's something that we really let the VCs take the lead on. And then at a later stage, we come in and provide capital. But we want to know the companies. We want to understand what they're doing. We want to know the founders and the key guys at an earlier stage, and then come in as early as we think that we can get the right risk return. So for us, it's very much sort of right risk return. We want to have we don't want to take excessive risk. We don't want to take venture risk. We want to take growth risk rather than venture risk. And obviously the VCs are taking that earlier stage risk in their business.
So you don't really get out of bed for less than 500 million?
Sorry?
You don't get out of bed for less than 500 million?
No, that's not right at all. Okay, so that's valuation, valuation, not investment amount.
All right, sorry, I couldn't resist. Look, style-wise, DST's been known for being very much hands-off. Here's a very large check, we'll leave you to it. But I'm getting the impression from talking to you already, this isn't the case so much now. You're getting more involved with the investments.
Absolutely, and I think that if you end up coming in at a relatively late stage, you obviously deploy a very significant amount of capital. You have a lot of discussions with the founders and the management team, and you end up just getting involved in lots of different things. We're spending, perhaps I should just talk about myself, and I'm spending easily more than 50% of my time just on existing portfolio companies at present. So obviously what we try to do is we try to bring our network to the companies that we invest in, try to help them with all kinds of things. But what we also are very mindful of is that, the founders and the CEOs, they are running the business. We're there if they need our help. We don't want to push our opinions on them. They sit there and think about the business 110% of their time. We'll spend a much, much lower percentage of our time thinking about their particular challenges. So we take the cue from the founders and the management team.
What sort of things do you normally get involved in helping with? What sort of advice are they looking for? What can you bring?
Well, it's very interesting because many of these late-stage businesses, of course, out of the US and Europe, and increasingly China as well, they're really looking outside of their home regions. And I think that's, having then looked at loads of different business models in their particular space, I think that we can perhaps, add a few perspectives that they might not have thought of. We can certainly help them with different introductions and getting to know different companies in that space. And that's happening much, much more than was the case 5 years ago. And of course, if you look at the big companies, they're all really looking outside of their home regions. And then obviously, as companies move towards an IPO, you end up, excuse me, you end up having a lot of discussions about, go-to-market strategy for that IPO. And typically, it's the investors that came in later that end up leading that discussion with the company.
As a former banker, you know a bit about the IPO process. So yeah, you've got that down pat. Now, on valuations, that's something that always comes up. If we're sitting around talking about unicorns every day, and if you read the Financial Times, we often are, or we have been, then we've either got the name wrong or valuations are too high. Now, they seem to be easing, and I'm hearing about down rounds and ways of getting around down rounds and funding. Yeah. Has the market cooled sufficiently, or is there more to go?
Good question. Who knows? I think the market has definitely cooled, and it's cooled globally. Cooled in China, cooled in the US, cooled in Europe, and in India. I think that it is more difficult for founders to get capital. There's no doubt about it. Many investors that were there 36, 24, 12 months ago are not really in that market anymore. I think that you had a lot of new investors coming into tech and late-stage market, which we don't really see today. And as you said, or as you alluded to, there are a number of different ways to structure terms as well, so that you can keep the same valuation, but obviously you provide, companies end up providing further upside or downside protection for investors.
Are you generally in favor of that? I mean, to me, it just, company has to make promises to you now for down the road that it must pay up. And it seems a little bit fiddly and finicky. If the company is worth less, it's just worth less.
That's true, but very often the company's founder is really, really keen not to have a down round. And there's existing investors, they don't want to have a down round because they have to mark down their investment. Some of them might be fundraising, that causes a lot of problem that could cause problems for their fundraising. Also for employees, they're issued stock, they're issued options. To see a down round, is not the best thing for the company. So generally speaking, there's quite a lot of resistance among boards and founders to accept down rounds. But of course, they do happen, and they will continue to. I think that we will definitely see more down rounds going forward. Like
proper down rounds or adjusted, tweaked, finessed rounds?
I think we'll see both.
Right, well, we'll look out for those. One question I did want to ask, I mean, you work with Yuri Milner, who's now one of the most storied investors in the tech space. You know, I see reports of, 24-hour secretaries working in shifts, calls at 3 in the morning, and then you spend 3 hours on the phone with him. Is that true?
It is true. You know, he's very passionate about the business. He, loves talking to founders, loves interacting with founders. I just got off the call with him, and it was midnight California time, and we had been on a 2-hour call with a few of the other partners. So, he's just passionate about the business, and that's what he's interested in. And that's been great for DST, of course.
Okay, if he calls you at midnight his time and it's midday ours, I'm okay with that. Do you get called at midnight, 2 a.m. Hong Kong time?
Less than before, because I think that he tries to be more sympathetic to people's time than perhaps a few years ago. But when you run a global business with a pretty small team and you have these partner calls, it's always inconvenient for a few other partners. So it's just something that you have to accept.
At least if it's a scheduled call, you know when you're going to be awake at 2 in the morning. Now, one last question as we're out of time almost. What's next? What are you focusing on right now? What are you thinking about investing on that I'm going to be standing here talking about next year?
I think that there's still going to be a lot of opportunities in consumer internet. And I think that very much driven by the fact that there's still, I think, a couple of billion people who are going to come online in the next 5 years. Obviously, all of them are going to come online through mobile devices. I think that there's probably around 3 billion connected mobile devices today. I think that that's absolutely going to go to 5 billion in the next few years. And obviously, with broadband speeds increasing, I think that there's going to be a lot of new businesses, that I'm sure exist already, but will continue to scale, and businesses that may not exist today, but will be formed over the next few years.
Okay. Different models. Okay, one last bit then. FinTech. I, as a journalist covering finance, get pitched on FinTech startups and FinTech ideas every single day, pretty much. I'm a little skeptical it's changing the world. What do you think?
I think that it will change the world, but I think that very often these changes take a slightly longer time than people expect. I think that the other thing is that many of the incumbents, I was just thinking about some of the investment banks. I think that Goldman Sachs, they have twice the number of software developers compared to investment bankers. So, they are in a position to fight back as well. And then I think that in certain other parts of the world, especially in China, regulators obviously play a very strong role. So you need to sort of figure out, as a founder, how can you create a business that will be successful, given the regulatory environment. And also, also in China, where I spend most of my time, you have very strong incumbents. Companies like Ping An, setting up online subsidiaries like Lufex. Obviously, Ant Financial is an absolutely massive company. Tencent backing WeBank, etc. So a lot of the big guys are also aggressively going into this space.
Okay. Well, I could keep going, but I think we're being told to stop now. So I'd just like to say, John Lindfors, thank you very much. That was the easiest 20-minute interview of my life, and I could carry on for a long, long time. And everybody, say thank you to John.
Great. Thank you. Thank you, Jennifer. Thank you.